Hey everybody, Dave Lewis here with High Impact CPA. Hey, happy Sunday, everybody. I'm stuck in my black void here until we get the walls painted. We got a new studio coming up, so really excited about that. In the meantime, I'll just sit here in this blackness and figure it out from there. But anyway, today I kind of wanted to talk about a question that I get a lot from clients and potential clients, and that I've seen all over the internet here. And that's, how do you pay yourself as a business owner? And the answer to that is, of course, as always, it depends. It depends what your tax structure is. So I'm going to go through the four different typical ones, and try to provide some clarity in that area. So let's start with sole proprietorships. So this is where you're going to file a Schedule C on your tax return. It's just you. You haven't formed an S-Corp. You're not in a partnership with anybody else. It's essentially just your business. You might be an LLC taxed as a sole proprietorship, or you may just be starting out for the first time. Well, paying yourself in this manner is really, really easy. All you got to do is make a bank transfer, cut yourself a check out of the business account. And that's because what we're really focused on when we talk about paying yourself is actually who's paying the payroll tax, who's paying the Social Security and Medicare tax, and how does that flow through? How does that work? So for a sole proprietorship, you're going to pay your self-employment tax, your Social Security, your Medicare tax, and a few others we won't get into right now, based on your net profit at the end of the year. So whatever your revenues minus all of your expenses are, that net profit amount, you're going to pay self-employment tax on that if you're a sole proprietor. So there's really no need for you to be on payroll. You don't have to cut yourself a check, send in quarterly payroll reports, anything like that. You're simply just going to make a bank transfer, cut yourself a check. And as far as the accounting goes, it's an owner draw. It'll just go on your books as an equity transaction. Now, it starts to get a little more complex as you start going up the different tax structures. So let's talk about partnerships. Same sort of thing. So with a partnership, you are not considered an employee of the company ever. If you are a partner, your classification is as a partner. So there's two ways you can pay yourself in a partnership. One is through guaranteed payments. So this is essentially payments made to you as the partner for the services that you render to the partnership that have nothing to do with the profits from the partnership itself. So whatever your partnership agreement says, however you're going to split profit or losses between all the different partners doesn't really matter. If you're providing services and there is an expectation that you're providing those services or providing capital or anything like that, you're going to pay yourself a guaranteed payment. Now, those guaranteed payments are subject to FICA taxes. So again, those self-employment taxes, Social Security, Medicare, a few others, if they apply to you, you're going to pay that. You can also take a distribution from the partner. So a partnership distribution, basically an equity transaction, says against the capital that I've put into the business, plus or minus profits or losses over the year, I want to take a distribution out of that. I want to take a capital draw. And those are not subject to self-employment taxes. So, but you got to be very careful here. There's some limitations as far as what your basis is in the partnership. So what you put in plus profits minus losses and a few other, unique things in there that are separately stated. But two ways to pay yourself: guaranteed payment or a distribution. Now let's talk about S corps, because that's where it gets a little bit more hairy. So in an S corp, you as a shareholder and well, you as the owner are going to wear two separate hats. You are going to be an employee of the company, and you're also going to be a shareholder in the company. So the reason that people select S corp status and why it's great for most small business owners is the ability to save on that self-employment tax. So in an S corp, you actually have to get yourself on payroll. You've got to be cutting yourself checks. You're going to give yourself a W-2 at the end of the year. You are required to pay yourself a reasonable salary. Now, what reasonable means, that comes down to a little bit of analysis in what your job duties are and what you're providing to the company, things like that. So it's not a one-size-fit-all type thing. But the way this works is you pay yourself a reasonable salary. You're going to pay self-employment taxes on that reasonable salary. And then The other way you pay yourself is through a shareholder distribution. Now, the beauty of this is the shareholder distribution is not subject to self-employment taxes. So it's a balancing game. We got to make sure we get the reasonable salary, and then we take the shareholder distribution. And as the profits in your business start to increase, you get exponential tax savings through the ability of paying yourself the salary, but then being able to take larger and larger distributions the more profitable you become. So two ways in an S-Corp: salary, shareholder distribution. Fourth thing I want to talk about is C-Corp. Now, for most of my clients, this isn't going to apply. There are some. So people in the tech space that are looking for a lot of capital really quickly, they need to raise funds from a lot of different sources. There are some that are C-Corp status. So this is your classic corporation. So paying yourself in a corporation, there's one big thing you need to understand, and that's double taxation. So you're going to pay yourself an officer salary. That's going to come out. You're going to pay self-employment taxes on that. The other way that money comes out is through a dividend. So you as a shareholder can get a dividend. You are going to pay taxes on that dividend, not self-employment taxes, but you will pay taxes on the dividend. So where it comes to double taxation is everything else that I've mentioned before: the sole proprietorship, the partnership, the S-Corp. These are all essentially, you as the individual owner are subject to the income tax. Everything is going to flow through to your personal tax return. With the C-Corp, the corporation itself is going to pay tax at the top level. And then as you get dividends out of it, you also have to pay tax on those dividends. So that's what I mean by double taxation. So C-Corps, you're going to have your salary, and you're going to have dividends. I know that was a lot to cover in a very short amount of time, and there are certainly nuances to every type of tax entity that we focus on. So if you have any further questions, feel free to reach out to me anytime. DM me. You can reach me at my email, david.lewis@highimpactcpa.org, spelled just like that up there. And yeah, reach out anytime. Again, everybody, happy Sunday. Hope you have a good one.